Hello, this is Rajat Bose here. We are going to discuss our market outlook, stock reviews and stock recommendations for the week starting July 10th and ending on July 14th. Now to talk about the last week, the week that gone by, that was an eventful week. While the global markets saw a lot of anxieties, lot of seesawing, but we seem to be totally deviating from that path. We were going strength to strength. On Friday, when the world markets were tottering, we were posting big gains. Come Friday, we posted a new high, 19,523. We projected, using Fibonacci retracements or projections, to 19,532 and the high was 19,523. But after posting that 19,523 high, the index came sharply down close to about 19,300, finally closing at 19,331. Come to the Bank Nifty. Bank Nifty posted a high of 45,655. From there it came down to 44,900. Bank Nifty, of course, did not show as much effervescence as the Nifty, but it was also pretty good. And cnxmidcap was defying gravity, shooting up just the way it does. But even that index also suffered towards the end. So that was an eventful week, the last week. We are now going to study them threadbare using our regular arsenals. The week began for the Nifty with a gap, and that was perhaps the fourth or the fifth gap in succession, and that was also a very eventful thing, that after the gap, how would the Nifty behave? During the week, the Nifty showed a lot of bullish gumption. What you now see is the 75-minute chart of the Nifty as at the end of 7th of July, Friday. What you see there is that the 9-unit and the 20-unit moving average of the 75 minutes charts are in a bearish crossover. This bearish crossover suggests that there is a likely possibility that we might be headed for lower levels. And that lower level immediately, as we can see on the chart with the orange colored moving average, which is the 50-unit moving average, which is hovering around, say, 19,188. That was the closing level of the 20-unit, 50-unit moving average on this 75-minute chart. So Nifty definitely looks quite weak. Now we come to the year-to-date chart of the Nifty. Here I would like to point out one very important thing. Right from the time when the rally began in late March, on 31st March this year, Nifty crossed the 20-day moving average from below, and after that it has never sustained below the 20-day moving average. And this 20-day moving average is the source of the Bollinger Band. The Bollinger Band is actually made using 20-day moving average. So the upper Bollinger Band is the +2 standard deviation, the lower Bollinger Band is the -2 standard deviation. What is important about this Bollinger Band or standard deviation bands? If it is 2 standard deviation bands, as I have also mentioned earlier, that it actually encapsulates 96.1% data of the whole time series. In this case, the time series represents the closing price chart, or the all the closing prices of the Nifty. There had been, from say late March till about current date, the 7th of July candle, it is 62 candles, out of which 10 candles are above the upper Bollinger Band. And what I said, that 96.1% of the total data in the time series are captured normally by this plus the two standard deviation bands. What we see here is that 10 out of 62, which is roughly about 16% or so. So 16% where it should have been about 4%. So 4 times extra movement, 4 times extra recordings of the deviations, the deviation beyond the band. This can happen on 2 counts. One, either when it is moving up after a long consolidation at the bottom, it's shooting up to may post a breakout, or if it falls sharply after a long distribution, or it can happen at the end of a bull run or end of a strong uptrend, which leads to a crash. Because you have seen over the last, say, 8 or 9 trading sessions, we have seen 1, 2, 3, 4, 5 gaps. 5 gaps in 9 trading sessions. Unbelievable for the index. It is an index posting such gaps is a very rare event. That means it is the final surge on the upside. And exactly that has happened. Of course, we cannot say immediately that it has actually, there would not be another excursion on the upside, but suffice it to say that it is a warning sign, and once we fall below 19,220, which is the 9-day exponential moving average level, we might see further fall. Where can that go? At least 19,000. Now what you see is the weekly chart of the Nifty. It shows a gravestone doji. Similar gravestone doji was found in the week starting 2nd of May this year, but that gravestone doji did not give its effect, and it was negated by a strong green candle the very next week. But only thing is that gravestone doji was very much within the Bollinger Band. But on the weekly chart, you now see that the gravestone doji this time, though happened, the close is within the Bollinger Band, but the top was above the Bollinger Band in the gravestone doji. So there is a possibility that we might see lower levels. Nifty posted a new high of 19,523. After that, on the same day, that was the last day of the session, it fell to 19,300. That was a big fall. You know, on Friday morning when I was reading a pink newspaper, the business newspaper, that showed a comment that was a justification that maybe the world markets are down, but we are marching ahead. We are an outlier kind of a thing. Our performance, economic performance, corporate performance, all that are going great guns. But during the day, something different happened. After the first 15 minutes, the Nifty started falling and it closed. It went down to 19,300 to close at 19,331. That was the Friday's close. So it's an eventful week. The curious thing about Bank Nifty had been that there was a session during the week, that was Tuesday. It posted a new high, 45,655. It posted a low on that day, low of the week, 45,000. At least for the time being, that was the low. And you know where did it close? It closed at 45,310. and the opening was at 45,301. So that was a kind of doji at the top, and this kind of a doji at the top with so much of excursion on the upside, that is to the high, also on the downside 45,000 downside. At the total range of the movement on that day was 655 points, and the close and the open had been in the middle. Why am I saying this? There is a reason behind this. What's that? When you see such a thing, you know that the bank nifty lost its directionality. Directionality in the sense that it was also going up and up, but that was a curious candle. That is a doji at the top with long-tailed doji, long wick doji. That was a signal that bank nifty is gasping for a breather. Now we come to the 75-minute chart of the bank nifty. The 75-minute chart of the bank nifty shows one thing very clearly. If you look at the last 5 candles on the extreme right, you will see first a doji, then a red candle, which is actually a bearish, long bearish candle. Then the movement settled around just below the 44,900 mark, and finally there was another attempt to close higher, pushing the nifty beyond the 45,000 level. That 45,089 had been the high of the last candle, yet it closed at 44,892. So this session's negativity has been very pronounced on the first 75 minutes. Then there was a major sell-off in the second 75 minutes of Friday, and towards the end the recovery attempt was also aborted. The YTD chart of the bank nifty tells a lot. I would like to draw your attention to what happened on Tuesday. I have a little earlier referred to this. Now with this chart in front of you, you can see that the open and close are around 45,300 and 310. It's only a 9 points difference actually, and on the upside there has been a sharp rise to 45,655, which is the all-time high for the bank nifty, and the low that very day had been 45,000. So it was a 655 point move. There is something to learn here. When you see after a protracted upswing continuing for several months, and you find you find this kind of a doji pattern, long-tailed doji we call them, and these long-tailed dojis where upper end of the candle and the lower end of the candle, both the wicks are, the tail and the wick on the upside, both are about the same. That shows that the directionality of the uptrend has been lost. The bulls are no longer in as much firepower or as much gumption they are producing. No, they aren't. So generally this indicates a top, or at least it gives you a signal that a top is nearby, or the termination of the uptrend is nearby, something of that kind. And exactly that has happened over the next 3 days, Wednesday, Thursday and Friday. Of course, on Thursday, much to my surprise, there has been a rally. Maybe it was because of the weekly option clearing day for the indices, but now it is only the nifty. Bank nifty actually settles on Friday. So Friday, see the thing that has happened. Opening prices of Thursday was 45,060 and opening prices of Friday is 45,118. Despite the fact that the Thursday's close had been at 45,339, 45,340 kind of. From there it was a more than 200 point gap down, and then this fall has happened, and it is very close to the 9-day exponential moving average, which closed at 44,804. So what I tend to think is that it is actually headed lower. 9-day will definitely be conquered. There is every possibility that it would go below that. A taste of the Bollinger Band earlier, the earlier highs 44,498 to about 44,350, that kind of levels might be tasted. Even the 20-day moving average at 44,235 could well be tasted next week. It is actually a signal that the erstwhile uptrend in the market might have been terminated, and we might see either a consolidation or a fall or a pretty much volatile range bound movement that might ensue. But one way traffic like the thing that we have seen in the recent past, that is not going to be the case. The weekly chart shows a gravestone doji. Again, the gravestone doji, as I was discussing in case of Nifty, gravestone doji has negative implications. Earlier uptrend was terminated by a similar pattern, not exactly a gravestone doji. That was an inverse spinning top that happened on the chart. If you look at around end of December, that thing happened. Similarly here, that might happen, that this is signaling a termination. But the termination, first signal of a termination would come only when you see the 9-week moving average at 43,943 gets taken out, and if it were to fall further, that would accentuate the case. cnxmidcap. During the week, the midcap index also posted a new high. The new high above 36,000. Midcap index was showing the maximum strength. But you know how? It was showing that strength on the back of hugely leveraged buying. A newspaper reported that 30,670 crores worth of funding has been used by the retail segment to buy stocks. So you can easily understand why this phenomenal performance, where from this phenomenal performance in the CNX midcap has come. CNX midcap needs to be studied because Friday and Thursday it shot up, Friday it opened at the highs, close to the high and fell. So we need to study CNX midcap in detail. Here we start with the 75-minute chart again, and a similar pattern that of the bank nifty or the nifty is seen here. Mostly on Friday all the three indices move in a similar fashion. First there is a small, first 1 hour and 15 minutes, then say by the time we reached say 11:45 or so, the major fall has already happened. After that there was some kind of buying sustaining it around the 20-unit moving average that you can see on the chart for CNX midcap. In the 75-minute chart it was maintaining on the 20-unit moving average. On the last 75 minutes, that is between say 2:15 p.m. to 3:30 p.m. on Friday, what we find is that there was a similar gravestone doji. This gravestone doji suggests that throughout the market, be it the Nifty, Bank Nifty or the CNX midcap, all three of them tried to post a recovery, but the recovery was aborted. So bulls actually failed to close the week at a promising note. It sort of came down quite a bit. Now if we go to the daily chart, what we find is that exactly whatever was gained on Thursday, that was negated on Friday, and in Friday we had a higher top. On Friday we saw a top of 36403, just like the Nifty. cnxmidcap also posted an all-time high on Friday, and thereafter it failed. And closed much below. This time it closed at 36076.80. That is the close, 36,077 kind of. Now what we need to see here is the 9-day exponential moving average, which is located at 35805. Nifty, the CNX midcap needs to fall below that and sustain there. Only then there will be some real sign of weakness. Otherwise, the kind of strength that CNX midcap has shown, as I said earlier about the CNX midcap, that it is emboldened by huge margin funding, huge fund, borrowed fund, leverage money coming in to the market, and that is mostly going into these midcaps. It is the amount is huge, 30,670 crores as per a Pink newspaper report this last week. So that kind of leverage buying has happened here. So CNX midcap needs to see the breakdown of the 9-day exponential moving average at 35,800. Then it should go even below the 20-unit moving average, which it has never closed after the bull run began. Never closed below that. So if we see a close below 35,300 now, which is the 20-day moving average level of the CNX midcap, only then we can think of a termination of this humongous bull run in CNX midcap. The chart of the CNX midcap shows a kind of a spinning top, a small doji, whatever you call it. It suggests some kind of an indecision, some kind of a pause. Although when we were looking at the 75-minute chart or the daily chart, it showed some weakness, but here there is no such weakness. That's why I told you that unless we see a fall below 35,300 for a bare minimum, only then we can say that the CNX midcap index has turned bearish. Otherwise, it would still be a course correction. So 35,300, first 35,800 and then 35,300. These two levels need to be watched before we can come to a conclusion. But Nifty and Bank Nifty have actually showed considerable weakness. So with this, I conclude my index studies for the week starting from Monday 10th of July to 14th of July, Friday. So let's see how things pan out. If you like my presentation, if you like my commentaries, if you like the way I look at stocks, then don't forget to press the like button, subscribe to my channel, share it among others, and don't forget to press the bell button so that you get the notifications from YouTube. You know, YouTube will tell you when I post the next video. Jubilant Food. We recommended Jubilant Food a few weeks back at 492 rupees. Remember, we had our pizza and the beer. We are actually coming to review how was the session. Can we have another pizza and beer? Well, Jubilant Food this week closed at 493. But before that, it met the first target of 502. The second target at 515 was missed by just 2 points. It posted a high during the week at 513, but after that it came down because the market was seesawing, market was volatile. It also became volatile because it was trying to cross its 200-day exponential moving average and the 50-week moving average. That was quite a bit of selling pressure. It went down to 485. Finally, it closed the week on Friday at 493. Is there any change in outlook? Not at all. We are taking things in our stride. There is nothing to worry. Our stop loss has not been hit. That was at 475. I really do not expect it to hit the stop loss because it has got enough of strength. But since the market is volatile, it could show a lot of seesaw movements. That can happen. But I am highly optimistic about Jubilant Food crossing its 515 resistance and move beyond that. So over the medium term, our targets remain the same, 558. 558 target remains the same, the stop loss remains the same, and you hold the stock for now. Jubilant Food has closed at 493.25. We recommended it at 492. It went up above. It actually met the first target of 502. We gave 3 targets, 502, 515 and 558. It hasn't gone below the stop loss level of 475 in between. Jubilant Food, what it appears is that it is on a consolidation mode and it has not taken out the 200-day exponential moving average in a decisive manner. The 200-day exponential moving average, it is currently ruling exactly at 500 at the end of last week. So it needs to stay above that, which I continue to think that it would be able to do that because it's a very good. After the fall, there has been a consolidation and then it is moving up and it is consolidating around the 200-day now, and it would be conquered, and after that it would move up. We have kept our final target as 558. You can see that there is a 2.618 Fibonacci level of 558 which we have chosen as our final target, and we continue to think that the level of 558 would be achieved going forward. Maybe a couple of months or maybe 1 quarter to about 2 quarters might be taken because there would be a lot of seesaw movement in the market. United Breweries. United Breweries we recommended at 1448. It went up to 1553. Pretty good performance. I would say it was quite a good performance given the kind of movement that we have seen earlier. However, the 50-week moving average and the 200-day exponential moving average, they were just a little higher than 1500 mark. That's why a lot of profit taking happened, especially on the Friday. It came sharply down from higher levels to 1500 level, finally closed around the 1500 level. Last day there had been quite a bit of selling, but if you look at the United Breweries chart, you will see that this kind of a movement in United Breweries continues to happen despite the fact that the stock tends to move up on weekly basis, on a medium term basis, because the downtrend has come to an end long back and now it is on an upswing. But in line with the market sentiment, United Breweries also fail. But I am quite hopeful that it would soon cross its 50-week moving average at 1517 and continue to move ahead. But before that, there could be a bit of volatility. Do not get too upset about it. It still retains its medium-term bullishness. If you like my presentation, if you like my commentaries, if you like the way I look at stocks, then don't forget to press the like button, subscribe to my channel, share it among others, and don't forget to press the bell button so that you get the notifications from YouTube. You know, YouTube will tell you when I post the next video. We have come to our most interesting section. There are new recommendations. Following the volatility that we saw during the last week, I have chosen a stock for you. That stock, in the month of February, it was at 500 level, then there was a big fall, it came down to 380. It is still languishing at the bottom. I say languishing. That's not an encouraging word to say, but you know, it is forming a base. When you see the chart, look at the chart. Mahindra Logistics is not a market leader. Market leader may be some other companies which had been showing good performance. But I am banking on one thing. According to the strategy of the group, Mahindra Group, whatever companies they are retaining, they have enough confidence that they will excel going forward. And Mahindra Logistics is one among them that has been retained. So it has fallen in the month of February from a level of around 500 to 350 initially, and then it fell to about 380, then it fell to 350, and then there had been a long consolidation till about late June. Early July it has moved up say to about 380 levels. As you can see on the chart, the cyan colored moving average is the 200-day exponential moving average. Mahindra Logistics 420 is our first target when we give a buy call. We are giving the buy call at 380 and our stop loss is below 345 on closing price basis. We are expecting it to get past 420. Going above, we see that it might actually move to 480 to about 500 levels. That's what we are looking at. So we expect it to achieve this over a period of 6 to 9 months. So our targets are 420, 475 and 500. You take it 475 or 480, whichever. I mean, it doesn't really matter. But 6 to 9 months, it is a very slow mover. Why I chose the stock? I chose the stock for the simple reason that it is forming a long base. Accumulation has been happening. Supply is getting absorbed. Once the supply is fully absorbed, it will conquer its 200-day exponential moving average. And I have kept a modest target of 475 to 500. Initially, of course, the 200-day exponential moving average is the target. But this one will go beyond its 200-day exponential moving average and at least move up to 500, if not higher. Suffice it to say that this actually offers a very low risk opportunity. If you are buying at 380 and your stop loss is at 345, you are only staking about 10%. 10%. From there, the jump potential is about 100 points or even more, 120 points. So that would be a 1:3 or 1:4 kind of a trade. So it's a very good trade, even if you have to keep it for 1 year. So Mahindra Logistics, buy Mahindra Logistics at these levels. Now the second stock, Avanti Feeds. our first candidate could not succeed to take out the 50-week moving average, but this time Avanti Feeds, after a long consolidation, is crossing its 200-day exponential moving average as well as the 50-week moving average. Avanti Feeds is a shrimp feed company. Most of its sales are to the US to the tune of about 80%, rest in India and Bangladesh. So Avanti Feeds is now doing well, and Avanti Feeds chart suggests that there is a good recovery that is already on. I would like to highlight the fact that look at the extreme right. The 200-day exponential moving average was getting tested since early June. From there, finally, Avanti Feeds on Thursday last week, it conquered the 200-day exponential moving average. The volume bar was also pretty big. It was unusually high volume. On Friday, in tandem with the market sentiment, in tandem with the fall in the market, Avanti Feeds also retraced a bit, but it did not fall. It did not fall much. To close at 406, it lost only about 3 rupee 15 paisa from the prior day. That is, the last the close on Thursday was of 409.25. This breakout above the 200-day exponential moving average after posting good results for the last couple of quarters, and this consolidation, and in between a dip around late March, early April, or in late March only, it posted a low around say 320. From there it has now come up close to about 400 levels. So there has been a recovery, the sharp rise from the low levels of 320. This is I would say this is a very encouraging, very positive setup for a good recovery in Avanti Feeds. Avanti Feeds is actually a shrimp feed company. It exports 78% of its produce to the United States, and rest is consumed in India and Bangladesh. So Avanti Feeds is a Hyderabad-based company, and it is now doing fairly well. This breakout is on the back of the last two results, and it is expected that the June quarter results would be good as well. So what I feel is that Avanti Feeds can actually do a good movement on the upside. I'm looking at Avanti Feeds going up to 509 initially, and then the next two targets are 581 and 620. Having seen such a long period of consolidation in between a dip to 320 and finally taking out the 200-day exponential moving average, I'm giving a long-term buy recommendation. This buy recommendation, the duration would be 1 to 2 years, and our final target is 620. Prior to that, 509 and 581 are the two targets for Avanti Feeds, and I would give a stop loss below 345 on closing price basis. So what I'm trying to tell you is this, that even if it meets the second target of 581, it would be a 1:3 kind of a trade for you. It's a very good trade for the long term. Now, when you look at the weekly chart of Avanti Feeds, you will see that it is volatile, yet it is in a range bound situation for the last several years. right from 2019 to about current date, it has shown spikes. It has fallen in a similar fashion because this is not an industry where you will see steady performance. There would be demand ups and downs, all those things are affecting that stock. But now we are actually buying it at the bottom, almost at the bottom. So I suggest that the targets that I've given is actually what it did achieve in 2022 and 2021. So same target it can again meet over a period of 1 to 2 years. So it's a good bet. With that, we come to an end of this week's discussion, this week's program. Thank you for watching. Thank you for being with me.